Ladies and gentlemen, welcome. My name is Artem. I am a CPA and managing partner of Torrent Accounting. Welcome to the Tax Show. Today, we're going to be discussing the infamous and very famous, it's all the things all at once, the vehicle deduction for your self-employment business. Again, for the focus of this video, we are going to assume you're a sole proprietor filing a Schedule C. Could be a single member LLC, that's a disregarded entity. The facts don't matter. The facts do matter. But here we'll be discussing vehicle deductions for self-employed individuals that file a Schedule C with the IRS on Form 1040. So let's kick it off. It's a great question. We get a lot of questions about this. How do you deduct it? A couple things before we begin. The one thing you should really have is a dedicated mileage log for whatever vehicle that you're using for business purposes. Whether it's 100% auto or even if it's a mixed-use auto, most of what we'll be talking today is a mixed-use auto. So you should have a mileage log. What is a mileage log? There's a number of ways to do it. There's automated softwares. There's the old pen and pencil scenario. Either one works fine. But what you really want to know for the sake of tracking your mileage is you want to know the start of your odometer, the thing that says the miles on your car, at the beginning of the year, so January 1st of any given year. And you have to know what that odometer says at the end of the year, the last day of the year, so December 31st, assuming you're a calendar year filer. Why is it important? Because you'll need to figure out what your total miles driven were during the year, total, personal and business, and how much your business miles were for the year. Why is that important? So a couple things. One, it determines your mileage deduction if you're eligible for that, or it determines your business use of vehicle. So let's say you drove 10,000 miles for business and you drove 20,000 miles total during the year. That vehicle is 50% business use, 10 over 20. So with those, let's begin. So there's two methods. There's the mileage, like we talked about. In 2025, the deduction for miles driven business-wise were 70 cents per mile. For 2026, it's going to go to 72.5. So it's either you can take the mileage method or the actual method. And so the actual method is where depreciation comes in, bonus depreciation, 179, all based off your business use percentage that we just discussed. So, and something important to note, so if you've been using the mileage method, so if you use a mileage method in the first year, you can go to the actual method afterwards. But if you use the actual method in the first year, you cannot track your mileage afterwards. So if you wrote off your entire vehicle purchase for your business in the first year, you can't take mileage down the road. The vehicle's already been fully written off. Very important, keep that in mind. So business use, let's get back to the percentages. So it has to be more than 50% business use if you want to take either 179 deduction or bonus depreciation for your vehicle. Deduction equals to the business use percentage. So let's say you bought a car for $75,000 and 80% was business use based off mileage. Remember, you're going to track that. If you're not tracking it, you're going to start tracking it with this video, right? You guys promise me? Because we'll be asking those questions. So it's a $75,000 vehicle, 80% business use. Your basis for that vehicle is $60,000 for business purposes for the deduction. So the max you can write off is 60 grand because only 80% of that $75,000 is business use. In case you're wondering why my head keeps turning, is I have my notes here. You have no idea how hard it is to make these videos, and I can't remember everything. So based on that, there's going to be a couple other things if you're going with a depreciation method instead of the mileage that you want to be aware of, and that is the weight of your vehicle. So what is important is for you to know the GVW of your vehicle. That's the gross vehicle weight. Why is that important? That's where that magic 6,000 pound limit comes in. I know you've all heard it. Everyone's been talking about it, but you want to know what your weight is if you're considering depreciation and maximize the deduction you can take on your vehicle. Usually it's on the sticker door of the car. You can look, it'll tell you the rating. Also, you can Google it. Fun fact, I looked up the G-Wagon yesterday. It is over 6,000 pounds. So for anyone really looking to itemize that business deduction, if that qualifies for your business and that is a appropriate use of an asset for your business, any car over 6,000 pounds would technically qualify. So let's just talk about the bonus depreciation timing of it with 2025, because we had some tax law changes with the last tax law that was passed. So if you had purchased a vehicle in 2025 between January 1st and January 19th, you're not eligible for 100% bonus, so keep that in mind. Everything placed in service after January 19th is eligible for 100% bonus depreciation. I mean, we all know 100% is better than 40%, but to break that down, you could, in theory, if it's 100% business vehicle use, write off the entire purchase price if it's over the 6,000 pounds using bonus depreciation. And so to go over those weight thresholds a little more, so if it's under 6,000 pounds, it's considered a luxury auto for IRS purposes. Your approximate limit is going to be about 20 grand that you can write off in the first year. It could be more, it could be less, but give or take. If it's between 6,001 pounds and 14,000 pounds, that's when you're eligible, and you could take 179 and then bonus depreciate that vehicle. Anything over 14,000 pounds is not really considered a vehicle. There's no SUV cap on it, no luxury auto cap. That's considered heavy equipment because most likely a 14,000 pound vehicle will be heavy equipment. It's not going to be a passenger auto. Just some background information why the weight stuff is important. And just to break down Section 179 versus bonus a little bit quick, typically Section 179 and bonus might allow you to get to the same place. 179 is limited to income, so you can't generate losses with 179 deduction. They do the same thing. They expense your vehicle. Depreciation, specifically bonus depreciation, can allow you to generate losses. Even though your business might have not had a real loss in real life, depreciation can create a tax loss, which is really great tax strategies. And you can also skip 179, just go back to bonus, consult your CPA, but all of those options are available. So again, for the example, let's use the $75,000 SUV. That was 80% use, like we talked about in the beginning. Your basis is $60,000 for tax purposes, for business purposes. If you bought it after January 19th, 2025, you can expense the full $60K if everything else is met. If you bought it before January 19th, your deduction might be around $40,000. So there is a difference. I know you can't go back in time, but if you do go back in time, make sure you buy it after January 19th. So that leaves us with mileage. So let's say you have a vehicle use that's under 50% business. It's an older vehicle, so the basis isn't that big, and you all of a sudden decided to start using it in your business, and you want to take the mileage rate, or you just want to take the mileage rate because it's a higher deduction. That's when tracking of miles becomes very important. It's important always, you have to have a mileage log, but this is where you get the 70 cents per mile, and that's kind of in lieu of depreciation. So instead of depreciating it, like I said, you're going to take the mileage deduction. So that's calculated based off your mileage for business, your total mileage driven, all the other expenses you had with your car too, those can play into it. So you want to make sure you're tracking all of your gas expenses, repairs, snow tires, insurance, excise taxes, all of that's important, and all that is part of that calculation if you're using the mileage rate. Another question that we wanted to cover too is whose name should the car be titled in? Should it be in your business name or should it be in your individual name? Both will be acceptable, especially if it's a mixed-use auto. So if you're an individual and you use the car personally and you use the car for business, most likely it's going to be titled in your personal name. That's who bought it, that's who's using it, and now your business is using it too. That's totally okay. So the car can be titled in your name. It's more so on the record keeping and payments that the IRS is focused on. If you're a construction business, for instance, and you're buying fleet vehicles and heavy construction equipment, all that should be obviously titled to your construction company's name, whether it's an LLC or an incorporated business. You want to keep everything inside the business. And so what are the key takeaways from here? Since you made it all the way here, we're going to summarize. So if your vehicle is under 6,000 pounds, the gross vehicle weight, then your deduction will be limited versus if it's over 6,000 pounds. And then mileage versus actual. Again, you can start with mileage and go to actual, but if you started taking actual expenses, you can't go back to mileage. That's it for today. Thanks so much for watching. I forgot to mention this in the beginning, but if you're here, please like and subscribe, and we'll see you on the next one.